Jeff, good morning. Great to be with you. I think there are two different issues here. What are central banks having to do because of the economic situation? And then potential worries about political interference in central banking and weakening of institutions in some countries. The former is quite isolated at the moment. You saw, of course, last week, Brazil, Turkey itself, and Russia tighten. I think there's always going to be some countries in emerging markets that have to be on the front foot when there's even a temporary spike in inflation due to their history, due to the composition of their economy. And we are now seeing significant divergence in global monetary policy, with some central banks like the ECB doing more and some emerging markets, as you said, tightening policy. So I think that's going to be a broadening EM story. Gradually, we're going to see more and more countries, as their rebound completes, start to remove policy. There's nothing wrong with that as long as they're doing it for the right reasons. Growth is solid, output gaps are closing, for example. What is at the moment, thankfully, unique to Turkey is how quickly they go through central bank governors. I think this is the fourth in the last few years, and is obviously very worrying given that the replacement seems to have some unorthodox views about the relationship between interest rates and inflation. So I think this is a combination of the early stages of monetary policy divergence globally and a very local issue in Turkey.
I understand what you're saying about Turkey, but as someone who sat in Hong Kong during the Asian currency crisis of the 90s, that emerged as a mismatch between where we were on policy in the United States and what was going on in emerging markets that had ultimately gorged on easy credit. How different is the situation for emerging markets this time round? Because it seems that many of the conditions are fairly similar here, and we find as US interest rates start to tick up through the Treasury curve that money is flowing out of some of these emerging economies, and they're having to react to that by tempting it back with higher rates. What are the risks of an accident?
Well, Jeff, I think you're absolutely right that the broad context now of rising bond yields is putting some funding stress on some emerging markets. We saw those throughout some economies in Africa recently as well, and the ones I mentioned. The huge difference, of course, in the late 90s is the lack of prevalence of fixed exchange rates in key economies with very significant domestic credit imbalances. That was obviously one of the root causes as well of that crisis. So I think we need to separate the possibility for a major systemic crisis in a whole region versus the difficulties that some high debt, high interest rate, weak credibility emerging markets might get into if US interest rates keep rising. And when we look at an economy like Brazil and like Mexico, where they had a very deep recession, growth rebound is not that strong, fiscal situation is problematic, and the political situation as well leaves a little to be desired from an investor standpoint. It's not out of the realms of possibility that we are going to see some isolated difficulties in parts of emerging markets in the next couple of years. But we want to stress that that is probably a pretty isolated idiosyncratic issue. And the broader picture for large parts of emerging markets, especially the North Asia complex around the secular technology story there, is something we still like for long-run investors.